Hello, welcome to the October 2017 edition of TAXtalk. We have something of a personal tax flavour today, and with me I have Sue Moore, who is our private client tax manager. Hello. And Caroline Miskin, who is our practitioner tax manager.
Hello.
My name's Anita Monteith. I've got a particular interest in small business tax, but mostly I look after tax policy and some of the legislation that has been published this year we're going to be talking about a little bit later on today. Let's start, however, with some very, very good news. We have just revamped and relaunched our Making Tax Digital Hub, haven't we, Caroline? All new stuff.
We have indeed. And yes, as before, it's got information for businesses, for agents and for individuals. And so one of the topics we're going to talk about today in particular is simple assessment, because it's only been within the last 2 weeks that HMRC has started to issue these simple assessments. They start to land on people's doormats. The original legislation was in Finance Act 2016.
So this is the end of the tax return saga, isn't it?
Well, that is open to question as to whether it is. Yes, it has become linked to George Osborne's announcement at the end of the tax return. But in fact, the tax charities, I'm aware, were talking to HMRC long before that about ways that there are certain groups of taxpayers could be kept out of self-assessment.
So it's a bit like the P800.
So it is all linked to the P800. So yeah, the system as it has worked up until now is that there are 40 million people in the PAYE system. Only a relatively small number of those are within self-assessment. So I think there probably hasn't been a lot of awareness as to how people who aren't in self-assessment deal with their tax affairs. And the way that it has happened in the past is that HMRC does a check at the end of each tax year and contacts the taxpayer if there's an over or underpayment with a P800 calculation. If there's a repayment, well, then that's relatively straightforward. But if there's an underpayment, HMRC will always try to code it out. That's always the first thing they will, first port of call, and that continues. That's not changing. If an underpayment can't be coded out, then HMRC will has asked taxpayers to make a voluntary payment.
Right.
Where a voluntary payment hasn't been made, that has ended up, the HMRC's only legal option was to issue a notice to file a self-assessment tax return.
So people had to just pay up out of the kindness of their heart, or be in self-assessment.
Which is where I've answered hundreds of calls on the tax aid helpline, which go along the lines of, I've got £1,600 late filing penalties, but I've never been self-employed or had any other reason to be in self-assessment. What's going on? And the reason was always because they were in PAYE, they had an underpayment, and they've ended up in self-assessment. So there's about 400,000 people a year where the underpayments can't be coded. So now what HMRC can do is they can send them a PA 302, which is the new name for these simple assessments, and to all intents and purposes it looks like a P800, but it is an enforceable assessment.
It's a shame they couldn't have come up with a different word for it. Simple assessment
SA.
is SA.
What does SA mean?
We talk about SA as being self-assessment.
And we had these simple returns, didn't we? The
short tax return.
The short tax return.
But it's nothing of that. It's not that.
No,
this is a new thing, and it's got legislative backing, hasn't it?
And so it's been used for people who underpaid tax in 2016-17, where it can't be coded, and for about a group of about 27,000 people who are in self-assessment only because HMRC needs to collect tax on their state pension over their personal allowance. So these are people who've only source of income is state pension, but it's over their personal allowance.
And the state pension has always been the real problem because it can't be taxed through PAYE.
Through PAYE.
In theory, it could. It could.
Okay.
Yeah, we tried that. We've tried that route. That hasn't worked. So I think the important thing is that people must check them, and a lot of the media coverage has focused on the fact that whether the accuracy of these calculations. My way of looking at that is, well, P800s have always been inaccurate, and actually this group of 400,000 isn't necessarily any more of a problem than the sort of 30-40 million other people whose tax is calculated outside of self-assessment. But it is important to check them. The payment date follows the rules for self-assessment, so it's generally 31st of January or 3 months and 1 week if it's issued late.
Is there an appeal system?
The appeal system is a little bit different, because what HMRC has done is introduce an informal query period. Well, it's in the legislation, it's not too informal, but a query period. So the 60 days from the date of the PA 302, in which the taxpayer can either by phone or in writing challenge the figures with HMRC. If that dispute has not been resolved by the end of those 60 days, there's 30 days from the date of HMRC's decision on the query, in which a formal appeal can be launched. So the routes are there to do it. And one thing that has become clear later, that actually if somebody discovers much later that the figures are wrong, well, I think at least in the early stages, HMRC are going to be quite open to correcting the calculation if they can see it's wrong. But we have confirmed that actually overpayment relief is applicable. So there is a route to challenge the figures, even if it only emerges much later that
that's sort of
that they are wrong.
4-year rule, isn't it?
Yes.
The $64,000 question: will agents be getting a copy?
They will indeed, provided they are signed up in the same with a 64.8, and that covers income tax. Then yes, they will. Agents do at the moment get paper copies of P800s, and they will get copies of these. They will get copies of these P800s.
And not only have you had lots of press inquiries about it, you've got a press event tomorrow, haven't you?
Yes, You and Yours, the consumer programme on Radio 4, is picking this up lunchtime tomorrow, going to cover that, and so I'm going along.
So we can catch you
going
on air
along to talk about my favourite topic of the moment.
No, that's great. Thank you very much indeed. We actually did have one of our viewers, our members, contacted us about this, so it's glad to be able to pick it up and cover it thoroughly. And if other people watching today have particular topics that they'd really like us to discuss in a little bit more detail, do please email us here at the Tax Faculty. You can either catch me, Anita Monteith, at ICAEW.com, or either of the others, or to the General Tax Fac.
I think there probably is one more point I should make, actually, and that is because what I've explained is what simple assessment is being used for now, but actually one of the big questions that people is asking is where it's going in the future and the end of the tax return point. And I think there have been figures in the media saying that 2 million people, there might be 2 million people in this system. I think HMRC is stopping and thinking at the moment. I think if people are going to be taken out of self-assessment and put into PAYE simple assessment, that's going to be done in tranches. It's not being rushed, and we will continue to have discussions with HMRC as they make decisions about people moving out. So it's not a mass movement of people out of self-assessment.
They're doing pensions now. Am I right in thinking that interest might happen in due course?
Interest might happen. People who are in self-assessment just because they got income over £100,000 must be a target.
About the child benefit, the 50
and Anita's favourite topic, high income child benefit. People who are in simple.
I was feeling really calm today.
It's self-assessment just because of that.
But they've been introducing lots of things, haven't they, to try and simplify it. So they've got rid of the age allowance, so that you don't have that to worry about. They introduced the £500 or £1,000 saving allowance. There's the £5,000 dividend allowance. But the problem is, introducing those to take some people out of self-assessment has in fact brought other people in, because some people may have more than £1,000 of interest, but previously they didn't have to worry. They were still a basic rate taxpayer and didn't have to pay any tax.
And that takes us on to the problems with the calculations.
Yes.
that you've been grappling with?
All sorts of problems with the exclusions.
So people who actually can't file online.
Yes. Now then, when they introduced these 0% bans, we predicted in the tax faculty at the time that there would be all sorts of problems in trying to program that and code that. And sadly, we were right. There are so many exclusions.
So you're always right.
Could I have that in writing in triplicate, please? So at the moment, there are 76 exclusions listed, but not all of them are live. A lot of new ones have just come on. This version isn't available yet on HMRC's website, but they've tackled a lot of the problems that were already known about.
So we've gone beyond MPs and members of the clergy.
Yes, and unusually, they're actually correcting in year. Normally, when they find a problem such that you can't file online, they just tell you to file as a paper return, and as your reasonable excuse, if you're after the 31st of October, you just have to say which problem it was that caused you not to be able to file online. And it's corrected for the next year. But because there were so many, they're actually correcting in year. And these corrections should go through by, I think it's the 23rd of October.
Yeah.
And so the software houses have been working with HMRC, because the thing is, the software houses, even if they knew there was a problem, they couldn't correct it, because if their schema does not follow HMRC's schema, then you can't submit any returns electronically from that
So
package.
they have to reflect.
They have to be
HMRC's,
exactly what HMRC says. So some of the corrections, they'll be coming through the 23rd of October.
People have been warned about this, haven't they?
Yes,
quite a lot of
there's been a lot of publicity. Unfortunately, looking at version 5, there's now going to be some more exclusions which are being caused because of the corrections being done on the 23rd of October. So, and not all software houses will be correcting, apparently. So some of the smaller software houses might not be correcting theirs. So you just need to be aware. Chargeable events has been causing a problem, and there's some corrections for that. But I found one playing around with my software, and that's still not. Well, it's an artificial situation. What I did, I put in somebody who'd got a chargeable event of £250,000 with just 1 year. So no top slicing relief. This is on a policy where you can get. And chargeable events, they're really a gain, but they're deemed to be income for tax purposes. Well, you do if you've got more than 1 year, but the example I used didn't have any other income, just got this 250,000. So it should have given me, because it's treated as savings income, there's no personal allowance because it was over the 100,000, 120 odd thousand, and it should have given me £5,000 of the savings rate band of 0%, and the balance of the basic rate band, which is 27,000, at 20%. But in fact, the software has given me the £5,000 starting rate of 0 plus 32 at basic rate. So it's given 5,000 too much.
It's eaten into that basic rate band and gone up.
And so that's been notified to HMRC now to see.
If anybody that's listening to this has any more permutations, should they get in touch with you?
Yes.
And we'll pass them on.
Caroline or myself.
Yeah, one of us will.
Yes.
Great. But it just does illustrate, doesn't it? The tax system is being used to give lots of exemptions and reliefs and new little twists. Some of them are exemptions. Some of them are just relief from a higher rate.
Yes.
Actually, coding all of this is too difficult.
Well, yes. I mean, and we said that at the time. There are just so many different alternatives. And if you didn't watch the webinar that Sarah Ghaffari and I did last year, and we've done an update of it this year, the way that you allocate the personal allowance, you can allocate that to your advantage. And it was the programming for that we foresaw the difficulty for, because sometimes you want to put it against this and sometimes you want to put it against that. And you have to go back to your exam days of sorting your income out into the 3 columns. and checking what your software is saying.
Yeah, and that is still both last year's and this year's webinars, and they are cumulative, so worth watching.
Yes.
They are both available still for tax faculty members and are free.
Yes.
So, and I remember watching and learning a lot, Sue, from your lecture on that.
Sarah was very good at explaining things.
I would commend that one to anybody who wants to catch up on the mental gymnastics required. Non-resident capital gains tax. We have to keep motoring on. Sorry.
Yes, non-resident capital gains tax. I mean, for many years there's been no capital gains tax. If you were non-resident and you owned a residential property in the UK, and when you sold it, there was no tax to pay.
Because you weren't resident.
Because you weren't resident. That's unlike most countries. Most countries have first taxing right on real estate in their country.
Nice.
We were too nice. And so a couple of years ago, it was introduced, and have no problems with that whatsoever. Where I do have issues is the fact that you have to notify within 30 days of the sale that you've made the sale. And in addition, if you're not already within self-assessment in the UK, you have to pay the tax within 30 days. Now then...
So you're in Australia, you sell a property in the UK, even though you're non-resident, you've got to be on it.
Yes. 30 days of completion, is it rather than exchange? Or
yes, it is the completion, but it's a peculiar definition of completion as well. On our website, there's all sorts. There's a whole string of posts where people have been caught out, because particularly the ones that are in self-assessment, because they've thought, well, I'm in self-assessment because I've been renting the property out while I've been abroad. I'll pop it on my tax return, and they don't tell anybody. And so the agent gets the information.
You do it. Sort of
or
some
they
months.
fill their own in, and so they might have sold it in May. So it gets to the end, 5th of April.
Long time later.
Yeah, 5th of April.
Yeah.
They get the tax return. They don't do that until November. And they slot on there that they've sold the property. Haven't made a profit.
And then the bomb goes off.
It does, because they get the late filing penalties. So you get £100 for missing it by a day, and then you get the 200-300s, and you get the daily penalty of £10 for 90 days. That's £1,600. Because you've now told them that you've not made a profit on it.
And why didn't you, as my agent,
tell me? And it's
a
husband and wife, so that's £3,200.
Yes.
And you've made no profit. Yeah. And so...
Anyway.
There has been a case now.
There has been a case.
And Judge Thomas was very scathing, saying that he felt that he was very clued up on tax, and he'd read these sections, and he thought it was a load of twaddle. And the case is the revenue's lost, no penalties.
It's worth reading, isn't it? Because he doesn't say twaddle.
He doesn't hold back in his comments.
In the meantime, HMRC is exercising its discretion not to charge the daily penalties, I think.
Yes, they are. Well, I think all penalties are at discretion anyway, but they only seem to have exercised their discretion over the daily penalties. But I don't know what's going to happen about those people who might have already paid them. So I don't know whether or not they can say, excuse me, can you exercise your discretion, please, and pay me back? I don't know. I don't know what they're going to do about that.
Yeah, difficult. We'll keep an eye on.
Yes,
and,
but it brings the law and this country into disrepute when they try to put in legislation to affect foreigners when the foreigners may not know anything about it. But it's not just foreigners. You may have in your client base a lot of people who are working abroad at the moment, and they might sell their house and not tell you until
your solicitor might know, or your conveyancer. But
it should be with the
conveyancer. But your agent won't know.
No. I mean, the conveyancing solicitor should be saying, oh, you're non-resident, but the conveyancing agent might not know that they're non-resident.
Because they may be using somebody.
Yeah. In other countries, you can't sell a house without using the equivalent of a solicitor. So in France, you have to use a notaire.
Yeah.
And the same in Spain. And they actually hang on to part of the proceeds.
Yes.
And until you've filed your tax return and sorted out what tax you owe, you don't get all your proceeds. So,
I enjoyed that particular experience myself a few years ago. Yes, it's a good one. But you're quite right, though. I mean, the legislation, and we are really getting rather fed up, I think, with the way legislation is being published. That's probably one for a different time. But we are talking to, I hope, HMRC and Treasury over the next few weeks about some of that. Trusts register, we have now published some guidance, haven't we? Sorry, Sue, this is you again.
HMRC have done some guidance, 33 pages of it. It's not on their website yet. We'll be posting it on our website today or tomorrow. But agents still can't access the register.
Why is it going on our website?
I don't know why they've not put it on theirs. I know from the past HMRC sometimes they have a long lead time in order to get it up.
I'm glad we can. At least we can put it
STEP
up.
published it. It was given to STEP, and STEP published it at the beginning of this week.
Right.
And when I asked HMRC for it, they actually referred me to the STEP website.
Help.
So it's the agents should be able to get on by the end of October, but new trusts should have been registered by the 5th of October, because that's the notification. It's the normal notification time, the 5th of October. They have extended that to the 5th of December, but now, because it's getting longer and longer without the agents getting in, 5th of December is going to prove tricky for these firms where they start and register so many trusts.
And the important thing is to realise that they will have to set up their agent services account in order to be able to use the trust register. And this will be the same agent services account that they will eventually use for making tax digital for business reporting. But it is something that needs to be done carefully, because it is the account is per firm, even if it's got multi-offices, is per entity that has a UTR. But the firm's own is linked to the firm's own UTR. So that does need to be carefully set up. So that's a bit of an issue as well.
People who are in the pilot and have already set themselves up, will they be able to use the same registration?
Yes, and they will have to use the same registration, because
MTS,
unlike the government gateway, you are only going to be able to have one agent services account. The system will stop you setting up two, apparently.
And you're going to have to port all your existing clients across to this new registration, is that?
Well, I'm not sure whether is going to be able to carry trusts across necessarily.
So you might have to do all of those by hand.
Well, the other thing on the trust register, we've been told all along that existing trusts would have all the information imported over from the 41Gs that have been submitted in the past. Reading through these guidance notes, I don't get the sense that there's going to be anything there. And so you've only got until the 31st of January for any trust that's had a tax event in 16-17 tax year to get those on. And it asks for so much information on settlors. It wants the national insurance number or the UTR. I deal with trusts that were set up in the 1950s. The settler's long since dead. I have no clue where he lived, what his national insurance number was.
I presume you and your little group of volunteers are still in discussions on this.
Yes.
Well, let us know, and we will use the Newswire to publish any news about this one.
Yeah.
Moving on, we've been talking quite a lot about complexity. One of the things that the government has announced, and which is going through in the wash-up bill, is of course the trading allowance. We had the two £1,000 allowances for trading and property income.
Oh yes. So you don't have to pay any tax on.
You don't have to pay tax.
Just legitimising what people have been done, really, isn't it?
Well, I think that was the idea, yes. I mean, it's to encourage you to let out your driveway. It's encourage you to trade on eBay in a small way. And if you don't declare it, of course, it's fine if it's below the £1,000 allowance. The one I actually wanted to talk about was the trading allowance. I think this is fine that they are trying to legitimise something and simplify the tax system. Personally, I'm not really sure that they've totally thought it through. Of course, you will get full relief if you are trading below the £1,000, and you're looking at income here, not profits. So income below the 1,000, no tax to pay, no tax return to do, no record keeping, no registering with HMRC. That's all great. Although, of course, moving forward in time, how do you know whether you're going to be below the £1,000 when you start off in the year?
Surely you have to keep some record. records if they ever, they pick you up as trading on eBay and they say, well, can you prove you were below the 1,000?
So that doesn't quite ring true. However, we haven't had a great deal of guidance, nor have we had explanatory notes really that are adequate to support this new legislation. But where I think it does get a little bit more interesting is for partial relief, because it actually works a bit like rent-a-room relief. So if your income goes over £1,000, what you're allowed to do is claim £1,000 as a deduction instead of exempt the expenses.
Sorry.
If your income is £1,100
right.
from writing articles as you sit at home, as I did, on maternity leave, not employed, so that's what you do.
So
you
take
now take £1,000 off. Now, if you're sitting at home doing that sort of work, I can tell you, you don't spend very much on expenses normally, so it's a gift. So I think the cost of this is going to be perhaps surprisingly high to the Exchequer, but that's great news if you are in practice and if you have clients who have very, very low overheads. This year they're going to get a £1,000 deduction.
No more arguments about what's allowable and not allowable, or how much use of your home.
I have my heating turned right up, so my hands don't get cold while I'm typing. Exactly, all of those sorts of things.
All that goes out the window.
And the other thing you can do is decide year by year whether you want to go with the £1,000 or whether you want to go with actual expense deductions. So it's really actually quite flexible. There are some exclusions. You can't use it for rent-a-room businesses. Why would you? You've got rent-a-room relief anyway. You can't use it for partnerships. You can't use it if you are in a closed company or where your spouse might be a participator. So the obvious, this set-up arrangement that won't work.
You can't use it for second businesses?
You can't use it if you've got another trade unless the combined total falls below £1,000.
So I run my own practice. If I traded on eBay, I couldn't have this £1,000.
Well, I think you earn more than £1,000 from your practice, Sue. So no. I know times is tight, but no. However, if your daughter, who I know works for you, was your partner, then that's a partnership. And so if you do a bit of trading on eBay then
as a sole trader, then it will work for you. Right.
So you can't have it as your partnership.
It's cheaper to keep her as an employee rather than a partner and forgo the £1,000.
So mean. Well, put her in touch with me and we'll have a little chat about that. So that's an interesting development, I think, anyway. We've got criminal facilitation of tax evasion that we wanted to cover very quickly. I think, Caroline, you were just going to point to...
Just to quickly remind people that this provision came in on the 30th of September, and firms need to look at their procedures to make sure that they've got adequate procedures to protect themselves against any accusation that their employees or associates were anyway involved in evasion. There's lots of guidance. We did a news item which had a link to the HMRC guidance, to a webinar, and then to the TAXtalk article by Jason Collins of Pinson Masons.
So that's all through the website.
So that's all the information is there. It's really just to alert people.
Excellent. While we're talking about making sure you've got things lined up, we should just plug GDPR, that's Data Protection Act with teeth. And we did that in a webinar with the IT faculty. You did one on cybersecurity, didn't you, 2 weeks ago?
Yes, Mark Taylor and I did that, and so that's now available on Catch Up to watch again.
For faculty members to watch that. I think we should just also talk about some future events. We have a budget coming up, 22nd of November. Our tax talk for November won't be on the usual second Wednesday of the month. We're going to do it on the Friday after the budget, so it will be 12:30 on Friday the 24th of November. And the plan is you're going to join me for that,
Yes,
aren't you,
yes.
Sue? And I think Frank is as
Yes,
well.
yeah.
So that will be the trio to cover that. We also have a couple of other events we wanted to talk about. Your intermediate guide to trusts, taxation of
Yes,
trusts.
as a follow-up, we did a basic guide, which Sarah Ghaffari and I did last year.
It's the Demon Duo again.
No, it's one of my volunteers, Gillian Banks, who's a director at PwC.
Great.
And we're doing that on the 25th of October. It was requested after the basic one. People wanted a more advanced one, and I'll talk more about the trust register on that as well.
Excellent. And that's free for tax faculty members. I think we've still got the cheap deal for joining the faculty going at the moment as well, isn't it?
I think so, yes, £25 for the rest of the year. And so if you're not a member, pay £25, you can get all the webinars that are on the website now, plus any new ones that we do.
And you don't have to be an ICAEW member.
No, you don't, no.
To join the faculty. That's great. We have on the 8th of November, Caroline, that's your big slot, isn't it? It's the first.
Yes, I think it's going to be Anita, Sarah Ghaffari and myself coming back and doing our MTD webinar, the first one after the announcements on the change timetable on the 13th of July. We've actually had to delete all our previous ones because they contain information that's no longer current. So we'll be sort of starting again with a fresh webinar on MTD on the 8th of November.
Yeah, and I guess we'll talk a lot about the VAT requirements from 2019 on that webinar.
I think we will, because they're the first in the queue now.
Yeah, charities, companies, everybody that's going to be in for that.
Yes.
Finally, the OTS has just published a new consultation. They're looking into capital allowances and depreciation. Again, yes, we were saying we've been around this one several times before. But if you have views on the capital allowances / depreciation debate, one or the other, do please look at the OTS paper, and you can find it through our newswire. We did a story with a link, and get in touch with Sarah Ghaffari, who is collecting people's views for us to submit to that. I hope you've enjoyed today's talk, and will join us again for our post-budget talk in November. Thank you for watching.
Goodbye.